What is the difference between a dealer and an investor?
A dealer holds property for resale. That's what they do. They don't intend to treat it as an investment to generate income from rents or for long-term appreciation. They're always looking to sell. A great example, a great case about 6 years ago, 7 years ago, this individual bought a warehouse in Colorado. Actually, probably more than 10. Bought this warehouse and he did a feasibility study and got all the stuff together and then tried to sell it. No buyers. So then he just sat on it, rented it out. Next year, he went in, checked the property out again, did another feasibility. He said, well, this isn't the right time. So he kept sitting on it. He sat on it for 4 years, but every year he did a feasibility to see whether or not it's the time to take it to market or not. He finally sold it and then claimed long-term capital gains treatment, that he held it as an investment. IRS came in and audited him. And they stated, it went to tax court because the IRS said you're a dealer in property, that you didn't intend to hold this as an investment. It's like, the hell, I held this for 4 years, right? How do you say I'm a flipper? I didn't turn around and just sell it. They said, yeah, but your intent, that's what we're focused on. What was your intent? Your intent was to sell the property. The fact that you couldn't sell it is not relevant in the analysis of whether or not you're a dealer or an investor. Tax court agreed. And they said by him performing that feasibility study every year to look at the property to see if market conditions were right for him to sell it, put him in the category of a dealer and not an investor.
Gotcha. So for somebody who's flipping vacant land and, selling stuff within 12 months with intent, it's pretty clear we're all considered dealers, right? I mean, that's
They're
how
all
buyers.
Yeah.
And what are the tax or legal implications of being a dealer versus an investor?
Well, if you do it in your own name or you do it through a disregarded LLC, you're going to be treated as a Schedule C filer.
Mm-hmm.
So now all the income is considered active income to you. It's going to be subject to 15.4% employment taxes up to the threshold, and then it'll just drop down to the 3.6, whatever it is, Medicaid tax. On top of that, you're going to lose the ability to engage in installment sales. So this is the major problem that our flipping clients face. A lot of them flip properties in the Texas market on installment sales, lease options, bring someone in, lease to them, then they sell it to them on an installment sale. And so they sell them the property, they take down $5,000 down, and their basis, what they put into the property, may be $60K, and they're going to sell it for $120, but they're going to amortize it out on a 30-year AM, 5-year payment. So they just sold that property for $120,000, but they only received $5,000, and their gain eventually would be $60K. Well, the person who can engage in traditional installment sale reporting, the investor, they're going to recognize that as the money comes in. Mm-hmm. The flipper recognizes that $60K the day they enter into that installment sale. So now you've got $60K of income that you have to pay taxes on, for which you only receive $5,000 thus far. Now, where do you come up with the difference? Go to your bank account, because the IRS is going to expect that money. So people who flip property, they don't get the benefit of installment sales. They also don't get the benefit of 1031 exchanges. So you've just taken yourself out of the ability to engage in a 1031 on the disposition of an asset because it was not an investment property. So those are the three main drawbacks for people who deal. And I often tell people, because of the employment tax issue, the active income, we encourage those people who flip to run it through an entity that is treated as a C or an S corporation for tax purposes, so you can control that.
Yeah. And that's actually, that is one thing that does not apply to vacant land or any property that does not have a dwelling on it. And there's a little highly overlooked and very little known part of the tax code that specifies that that thing there, whether you're a dealer or not, that issue of having to recognize all the income at the time of sale, it applies to everything except when there's no dwelling on it and it's residential.
Yep,
Um,
yep, because it hasn't been put into use yet. I forgot that one. Thanks
yeah,
for
yeah.
yeah.
I know that's significant because I remember the first time I heard about that, I was like,
Mhm.
"What? Are you kidding
Yep.
me? This like destroys everything." Until I found out about that. So,
Yeah, 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 because it hasn't been put into use yet. Yep, I remember that.
and
See, my
I'm
blonde hair, it's just I'm getting older.
no, no problem. But it makes me wonder though. So you also mentioned the thing about as a sole proprietor or disregarded entity. So if you declared yourself as an S corp or a C corp, does that get you off the hook in some way?
It just gives you control over your receipt of income. If you're a sole proprietor, you have no control. If you make $175,000, all active income to you. Whereas with an S corp, you can cut the employment taxes by taking out a distribution from your S corp, or if it's a C corp, if let's assume that you and your wife you're working and you're pulling in 250, $300,000 a year, you're doing really well, and you don't want to pay 37% on that $200,000 you made from flipping, so you leave it inside of your corp and it's only taxed at 21%. The benefit being that now you've got more money to put into more deals the following year. So it puts more money back in your pocket. And if you need the money, loan it to yourself. I mean, pay yourself a reasonable salary. Always have to do that. But it just gives you more control. I'm a fan of C corporations because of the control feature that if it doesn't come down, if it's, I don't need it, I leave it there. And I will go toe to toe with any CPA every day of the week when they say, well, C corporations result in double taxation and they complain about it. Depending on your tax bracket, that is just a saying that they parrot over and over again without analyzing the individual. If you're in a 15% tax bracket effective, yeah, C corporation doesn't make sense. If you're in a 37% tax bracket, you'll pay less in tax with a C corp and a dividend than you would if you just took it into your own.
Yeah. Yeah, it's actually a good point because that's in my mind. Every time I hear C corp, I go back to the first book I ever read about this with the double taxation thing. And I was like, nope, not going to do it because of that. But you're right. I mean, there's always a situation. I mean, you gotta look at the specifics of your own financial picture and whether that makes sense or not. Um,
Yeah.
and I'm wondering, is it possible to be considered a dealer for one property, but an investor for another? It's not like you get this label that just applies to everything, right? It depends on each specific deal.
Yeah, it's going to depend on the deal. And the reason why we like to separate out the activities is that we want the corporation to be the dealer, you to be the investor. So any deals you intend to treat as an investment, you run them through disregarded LLCs or a partnership that flows back onto your 1040 Schedule E. You keep that dealer stuff inside of the company. So there's this clear line as to where investor ends and dealer begins. It begins in a separate tax-paying
Hmm,
entity.
gotcha.